Welcome to another episode of the Investing with IBD podcast. I'm your host, Justin Nielsen, and today is Wednesday, August 14th, 2024. And we're going to have a little discussion about how it's about kind of making sure that you're trading. If you're going to be aggressive, you got to be ready to reverse pretty quickly. And joining me, as he always does, to help along this conversation is Arusha Paris from O'Neill Global Advisors. How you doing, Arusha?
I'm doing well, Justin. It's good to have you back. And your hair.
I forgot that I was gone last week.
Were you gone last? I was like, wait, was he gone last week?
What was I doing? Yeah. I think I was on a plane coming back from Hawaii, so I should have worn the Hawaii shirt just for fun. But yeah.
But you don't look tan though.
I did not get to the beach at all. Thank you very much for rubbing that in. It was all about helping my daughter move into her off-campus housing at University of Hawaii. So I saw the beach. I took a walk so I could see it, but I didn't actually get into any sand. So yeah, maybe next time. I am considering going for the University of Hawaii versus UCLA game. Of course, I was since you're showing, I don't know if you noticed this, since you're showing your USC helmet, I'm not sure if you noticed this little addition to my background.
What's that? Your diploma?
That is Royce Hall up there and everything. So, and you know what? Not to say that we're gonna tag team on you, but I'm gonna go ahead and bring in another UCLA alum today as our special guest, Charles Harris, who he was at UCLA a little bit before me, but he also graduated from there. Of course, Arusha, you probably know Charles Harris since you guys both work at O'Neill Global Advisors. Charles and I we've known each other for almost 25 years. We used to sit next to each other. Yeah, back in the day.
Good old days.
Yeah, I got to watch Charles trade, and every now and then. This is when I was first starting out, and I would see, on the ILX machine, this big trade come in, this big block, and I'm like, oh, there's Charles. I just heard him make that trade. I just heard him call someone on the phone to make that. So it's great to have you back, Charles Harris. Of course, he's a portfolio manager, senior vice president over at O'Neill Global Advisors, jack of all trades, and an all-around good guy too. So welcome back to the show, Charles.
Thanks. It's great to be here, guys.
Yeah, great to have you. So as I said, we're going to talk a little bit about how when you have that, high conviction, you have to be ready to change your mind. And I think this is something that Charles and I both learned firsthand, watching Bill O'Neill, the founder of Investors Business Daily, in action. I mean, he would, Charles, would you agree that you could tell when Bill loved a stock, especially a tech stock, when he knew a little bit more about technology than he ever would? It was like, oh, he loves that stock.
Yeah, no, and he was a master of having the conviction, and one little blip happens and he can just reverse it and say, I don't like it anymore.
No. And then you ask him like 2 weeks later and he's like, what stock are you talking about?
It's good to have a short memory when you're a trader.
Yeah. And of course, we're also going to talk about the markets, because this has been, man, when I was in Hawaii, things almost fell apart without me. I'm glad I'm back to help prop up the market, because apparently you need me. So we'll talk about that. And of course, Charles will also share some of the stocks that are on his radar now that we have a follow-through day as of Tuesday. So that was some interesting news to happen. We've got our producer in the back giving us some whoops. He's ready to get his portfolio rolling. So Charles, let's talk market. NASDAQ Composite, S&P 500 both had a follow-through day yesterday. And as a reminder for our listeners, that just basically means we had a strong day in the market. After we had a bottom, we had a rally. We wait 4 days. After that, on that fourth day or later, if you get a powerful day on heavier volume than the day before, doesn't have to be above average, we call that a follow-through day. And that's a signal that maybe we are seeing a reversal of the downtrend. So Charles, what's your take on the market after this follow-through day?
Yeah, well, the market was it was a little extended, going into July. Mm-hmm. And I started the quarter out really, really strong, just personally. So it's almost like too good to be true, because I already had a good quarter in the first 10 days. And I thought I could maybe eke out.
Were you ready to go home and say, okay, my quarter's done? I think
you know what? I wish I would have. I should have. I was actually thought I could eke out a little bit more, and I'm always nervous going into July and August. These are typically not. This is usually when the market gets tougher. I don't think I've ever had a good August. July maybe, part of July, but August, September are usually tough months, and I think the market was very seasonal in that way this time around, where you kind of expect that weakness during the summer months, and and we got them. The market went into a pretty bad correction, given that it only lasted about 3 weeks. So for the Nasdaq to fall about 16% in, I think it was like 18 trading days. I mean, that's pretty brutal. And if you look under the hood at some of the stocks that got, hurt during this time period, like, Micron's down 46%, off its high. Nvidia fell 36%. I mean, that's, Nvidia, right? To fall that much so quickly off the peak. Meta down almost 20%, Amazon down 24%, Tesla down 33%. So, I mean, many, leading stocks running into the peak in July fell, between 20 and 40%.
Gosh, with some of those numbers, I'm surprised the Nasdaq wasn't down more.
Yeah, well, that's the thing. I mean, that is a pretty serious correction. We came all the way down to the 200-day moving average. We got support there. And, we've been bouncing, since we hit that low on Monday after the whole yen carry trade started to reverse. And this time frame reminds me of another period, a precedent I've been using going back to August 2007.
You know what? It's funny that you mentioned that, because when you said that you never had a good August or September, I was going to say, I remember you having a pretty good September 2007. What was it? Diana Shipping and First Solar.
In fact, I went through and I looked at my holdings during this time period and what was going on in the economy and the news. So if you you pulled it up, right?
Right.
Yeah. So there you go. So that little
this is even more. It almost seems like it was a little bit more brutal because it broke the 200-day, right?
Right. But the actual correction was only about 12.5%.
Yeah.
So we actually fell more this time around. And we were a little more extended going into it, but on that bottom day, it looks really similar to our Monday, kind of upside reversal that we had. And what was happening on that day, that was August 16th, 2007, was Countrywide, which was the country's largest mortgage lender, had to tap their credit line because, the subprime loan crisis was just getting started. And interestingly, I just, did the research just before this podcast to kind of remind me what was going on. The Fed had held rates at about 5.25% for about a year going into this, which is about where we are now, right? So, and very shortly after this, the Fed started to lower rates. And of course, we went into a recession, and the whole subprime crisis was a very serious, economic issue for the country. Went into a major bear market. I don't think we have anything like that on the horizon because none of those issues are in place now. We're actually fundamentally, I think, much, much stronger, although there are concerns that maybe the economy is slowing down. That's what all the evidence is saying. So the setup is very similar, in that rates were held high back then, just like they've been held relatively high currently. And you had kind of this headline news event, which caused things to plummet. And you're right, Justin. I was actually having a pretty tough year in 2007 leading up to this.
I think everybody was.
Well, no. I think I was the one standout on the team that was.
I remember this because what happened was, the year started out good. Then you had the Shanghai surprise in February,
Right. In February.
and that knocked everybody kind of down. And Bill was like, "Hey, didn't you guys see all that distribution on the Dow Jones Industrial Average?" And you're like, "Who looks at the Dow anmore?"
Yeah.
And then there was another pretty brutal drop. A little bit later that it was a tough year.
Well, it was definitely tough for me. I mean, I kept. I think I was up maybe 30 or 40% at some point mid 2007, and then I got hit again during this correction, and I was down to the I think lower mid teens. But I do remember Mike Webster was killing it.
Yeah, Crocs.
That I do remember. And he was killing it in Crocs, which I was banned from trading because I think the firm had too much of it.
Because Mike had it.
Mike had it. Some others had it too, and
once 2 or 3 portfolio managers had it, the others were blocked.
And I think Apple also was doing well, and I wasn't able to have as large a position as I would have wanted. So. But you can see the correction in Apple here during that time frame, and it doesn't look that different from the current correction in Apple or some of the leading stocks this time around. And I can tell you, coming out of this short correction in the market back in 2007, you're right, Justin. I had one of the largest gains I've ever had in a 2-month period. In September, October, I was up like 100%.
So can I guess? Can I guess the stocks that you're in after this correction?
After this current correction, or
no, after this one in 2007.
So why don't you guess?
Baidu.
Baidu was my number 1 position.
Well, Apple did really well, and Google.
Baidu, Apple, Google were my 3 top positions.
There you go.
Wow, how'd you know that?
Because I remember as a customer, I was like, oh yeah, that was the last hurrah in 2000, and it was like ridiculous how strong.
Yeah, and also dry ships.
Yeah.
And GSX were going crazy, and First Solar. So all of these were like stocks I was heavily trading back then. They were the leaders.
Yeah.
And
look at First Solar.
It was just amazing, what happened during that time frame. So I'm pretty, I try not to get too excited now when there's a precedent, because way too often I get kind of sucked into the precedent and hold on too tightly because I think I have my crystal ball and things don't pan out the way I plan. And it's one thing I guess we'll talk about is that I'm personally a little bit slow to give up on, when I find a good precedent to give up on it, and I give back typically way too much. So you've got to be pretty quick on the trigger if you're have a precedent that you think is going to guide you in a current market. So
Charles, let me just ask a quick question on this 2007. First, on the countrywide day, which was I think August 16th, right there.
Yeah.
Was that a pink rally day? Would that be kind of, okay? And then was and then follow through day was maybe a few days later on the 22nd. I mean, that was up 1.2.
It was the 22nd, and that day was one of the ones in contention because it was
low at that time,
1.25%.
Right.
And so we were going back and forth on what the follow through day should be, and Bill was like, "No, you have to include that one." So it's like,
okay,
1.25% it is.
Yeah, and that's where it kind of evolved into market school, right? Using those some of those.
Well, yeah, I mean so it was a 5th day follow through, if I recall, and for market school rules, anything 1% or higher is what we use, depending on the volatility, I guess, within the market, Justin.
Yeah.
But
right,
1%, and we'd rather err on the side of counting a follow through day that fails than missing out.
Exactly.
So that that's kind of the bias we have in that, and it worked. For 2 months, it kind of the
super strong
rally failed early November, and once it started to fail, like I was I remember, I think I've told this story several times. I was trading from home, and I had like 4 or 5 days in a row where I was losing millions of dollars. And Bill called me at home, and Bill never was like calling me at home. And I see his name on the phone. I'm like, oh crap, oh my God, I was like stressing out. And he just called and said, hey, I just want to make sure you're paying attention. Like,
that's my money.
Yeah, exactly. And
my money.
He asked me to kind of explain what I was doing, because I wasn't selling into this. I mean, I was like fully margined pretty much.
Really?
And I was up like 100% in 2 months. And at the end of the 5th day, I had given back 20% off the top, which was, now I'm up 60%. Like, that's pretty brutal to go from up 100 to up 60 in 4 or 5 days. And that was it. We just stayed in cash pretty much the rest of the year. But yeah, it was one of those really swift, hard corrections, and it's not really too unlike what just happened to us in the last 3 weeks. Mid July through last week.
Charles, so going back to the current market, what are your thoughts about this follow through day? And so what are your thoughts on that? Because it was I think Mike and a number of others on IBD Live talked about. I mean, I think it was Justin and Mike and Justin yesterday on the swing trader video. You guys were talking about you guys
kind of the fall through day that we didn't want ahead of the CPI.
Wedging, right, and going into CPI, right?
Wedging action. But yeah, so Charles, I mean, what are your thoughts? And do you like it more because of August 2007 or less?
Well, I'm using August 2007 again as a precedent. I think a lot of things line up. I mean, there's going to be a lot of headline risk, but usually going into an election or following an election, when we have certainty, it's usually a strong time in the market. Normally, when you start the year off so strong, it usually turns out to be a strong year overall. And given the damage that just occurred, we're not really up that much for the year compared to what I think we could be. Right. So I kind of like the seasonals right now. I do think I prefer to see a little more of a rest, and I would expect, and if things play out the way they did in 2007, we're going to have some drawdowns as the market is working its way higher, which I would use as opportunities to add. So, I mean, I'm not like going super aggressive right now. I mean, but I am incrementally buying, and there are a lot of stocks to buy. It's not, there's been a lot of damage, but there's also, I mean, I have a pretty healthy list of stocks that reported good numbers and acted well on their reports and are at or near new highs. So
yeah, I was pretty surprised at how many setups there were. Yeah. I mean, it's not tons, but I was like, wow, there are more than I thought there were going to be. When you're going to close the fall today.
Well, and also maybe this is something you could talk about, Charles, because at least for me, when I was looking at a lot of the setups, they weren't in the areas you would typically expect on a follow through day. A bunch of real estate, REITs, insurance. I mean, XLU is not looking too bad. The utilities ETF. So not what you normally think of these things as being very defensive, but they seem to be setting up kind of nicely right now.
Yeah,
and the relative strength is very powerful because they didn't come nearly as much as a lot of those tech names you mentioned.
Yeah, no, there's I mean, I think that, but there are tech names too that are still in position, and even NVIDIA is, clawing its way back, and, and it's, building what looks like the right side of something, right? So, I would expect some resistance, maybe at the 50, or, the market is a little, hasn't really rested since the upside reversal.
Right.
We've pretty much just moved up. So, I mean, I wouldn't be surprised if we, have a little pullback in here. And so I think, I'm going to treat them as opportunities. And if you look at the 2007 example, you had a couple of really bad, scary days on the way up following the follow through.
Mm-hmm. Yeah, for sure.
Like
On the
that
28th.
Yeah.
scare the hell out of everyone, and there too. So, we'll see what happens. I mean,
Well, it's interesting because we were talking about how one of the things that you, Mike, and I came up with in market school was when you close below the low of the follow through day. And that did happen here in August. But then you quickly had some subsequent follow through days to kind of let you know, okay, maybe things are okay. Then you pulled back again once you got above the 50-day moving average line. And then it was off to the races. And, so if you.
The nice thing to know is that it wasn't until the day that you just marked the kind of the breakout. That's really when things really got started.
Right.
So, I mean, it wasn't until that day that I really, really took off. I mean, maybe let's just say if I was up from, let's say, 15% to maybe 25% in that time period, I made most of the gains following that day or on that day and following it. So if you look at what Baidu did and Apple did, and I think Apple broke out pretty much on that day, a day or two in that day, and it was just a classic breakout. Like you didn't have to get in too early. It was just perfect. And Baidu was already very extended, but that was the leader in the market. Google was looking good back then. You mentioned that, Arusha.
Oh, that was a perfect breakout for Google.
Yeah.
Too.
So I mean, there were things did set up and gave you time. So there wasn't this rush to get right back in on the follow through day. I mean, the market gave you a number of weeks to kind of build your list, and then it gave you perfect pivot point on most of these stocks. So, that might be too much to hope for, but I'm hoping.
Well, you know what? To that end, when we come back, let's talk a little bit more about when you've got this strong conviction, when you're when you're very hopeful, how do you reverse yourself to make sure that you don't get hurt? Stay tuned. We'll be right back. We're back on the Investing with IBD podcast. Justin Nielsen here, along with Arusha Paris and my good old UCLA alum buddy, Charles Harris, who's joining us. He is a portfolio manager and senior vice president over at O'Neill Global Advisors, and someone that I've known for 25 years now, gotten to work very closely with him. So we were talking about this 2007 precedent that you've been using for the market, Charles. And is this a precedent that you've used before? Is this a reoccurring kind of drop that you've seen that you've used?
Yeah, that's a great question, Justin. I have used this one before, and this precedent is, really very, it's always in my memory because I had such big performance during this time period. So I'm always looking for a repeat of that kind of performance in a very short period of time. So I've studied it, and I know the stocks that I owned. I remember what the setups look like. And so I keep coming back to it, but honestly, it's never really worked exactly the same. So, I'm hoping this time actually maybe it follows through. And I think there are quite a few similarities, not just on how the stocks are set up, but just how we, the reasons why we corrected so quickly, the news on that bottom day, that kind of shocked the market. There was a similar shock this time around. But yeah, I've used it before, but not always successfully. So,
and to be fair, Charles, in the past when you're using it before, were you saying I think there are a lot of parallels this time around that?
Right.
Were you saying that a similar kind of fundamental stuff, or was it a little bit different?
You mean when I say
when we were using that precedent before, right? In other markets that failed, were you same approach? I think it is a little different this time, and this one's
a lot of times I'm looking more on I'm looking at the precedent more technically than I am like fundamentally and what's happening in the economy. I think this time around, just with rates being at an elevated level and on the brink of a lowering cycle, following the tightening that we've had, over the past couple of years. And I do feel like the setup is better this time around, but oftentimes I'm really more focused on just technically how the market looks. But following this, in 2007, when I had that huge surge in my account, I was actually thinking the market would continue to rise into the end of the year. And it didn't. It ended in early November, and I was pretty convinced that I was going to get a strong year end, and I was very slow to kind of unwind my positions, and I went from being up 100% or even a little bit more to just up being 60%, which is still a great year, but I lost 20% of my account, off that peak in about 5 days. So thankfully I did go to cash and remain in cash the rest of the year, but that's a pretty hard hit, and there was no reason to get hit as hard as I did. And even this time around, when I peaked in mid-July, just a month ago, I was slow to kind of sell some of the things that I was in. I was in CrowdStrike, I was in NVIDIA, I was in, what everyone's been trading. I never imagined they would come down as quickly and as hard as they did. So yeah, you've got to be careful. I mean, I'm thankful I'm now down for the quarter, not down a great deal, but I'm almost thankful I'm not down more, because when stocks fall 20 to 40% plus in such a short period of time, and if you're aggressive, you can pretty much get wiped out pretty quick. So thankfully I did get out, but not as quickly as I wish I would have. I think and we talk about this a lot when we talk about trading psychology and going from being in the black to being in the red. It's so important just for your psychology to be in the black, to at least have some profit, some cushion. It's just everything changes when you are now down for the year, down for the quarter, and your high water mark is up above. It kind of puts you on the defensive, because you're really afraid of losing more money as opposed to trying to capitalize on opportunities. It's like you just go in with trading not to lose more as opposed to trading to win. And
so Charles, with that, let's talk about also the dangers of conviction, right? Where you can develop so much conviction that it's great when you're in a bull market, and it gives you that staying power to handle a number of pullbacks in kind of a larger uptrend. But it can kind of go against you too if you have so much conviction in a company, or even in a market or something, where now you're almost losing the kind of the feel, or not seeing the character change technically.
Totally. It's like so ironic, because in order to, I think, really make a big play in the market, particularly in an individual stock, you really need to have ironclad conviction and really be able to handle the whipsaw days, and you have to really be able to withstand the heat. But eventually stocks actually do correct, and they do top, and you need to know when to run as well. And it's really, really tricky, and that's never been my strong point. I usually, my conviction sometimes is so strong that I will ignore really obvious technical cues that I teach in the workshops. We all know what some of the sell signals are, and unless it's like an offensive sell signal, which I'm very good about heeding, because I like to sell into strength. If you get a bad break or break below an important support level, I'm usually like, give it another day, or give it another day here.
It'll probably bounce.
Here's another day. Here's another day that's support. It's so easy to kind of fall into that trap of just vacillating and hesitating and waiting, when really, if you were to see the chart or not know what the stock was and someone looked at, someone showed it to me and said, oh, you've got to sell that or sell at least half of it, So yeah, that's tough. The stronger your conviction is, the faster you have to be to lose it. Which
well, and I remember you talking about this whole idea of the psychology sometimes, where you could recognize cues in yourself, like if you were getting too riveted by the conference calls on earnings and being too wrapped up in like, oh my gosh, look at all these great things that the company is doing. It would kind of make you start ignoring the technical sell signals, right?
Totally. Well, I mean, everyone knows how I, mishandled Tesla on the way down, where, I made a incredible amount of money and then literally almost blew up an account, trading heavy on margin while the stock continued to go down. And, I never dreamed Tesla would fall 75% off its peak. Like, that wasn't even in my calculus. I was like, that's not going to happen. So I don't have to worry about that one. But it did. And even now, I mean, the stock is, I've been holding it. I still have a large position in it in some of my accounts. It's been basically dead money for almost 3 years, or not worse than dead money, because it's still 50% off its high. But, I still have quite a big gain in it over the long term in these accounts. So, and I still have my conviction, but would I have been better off kind of heeding the sell signals, trading NVIDIA as heavy as I traded Tesla, and then go back to Tesla when the time is right? Yeah, that would have been a much better move. So yeah, it's tough. You really, and that's one thing Bill was great at. Bill didn't let his ego or his conviction get in the way of actually kind of being separate from the chart and being able to realize that, yeah, you know what, this is what's really happening. And it sounds easy when you're not in the stock. It sounds very easy to say, oh yeah, well, it's not working, just sell it. You can always buy it back. But when you're in it, and particularly if it's been something that's been working for an extended period of time and you've made a lot of money in it, it's interesting how your mindset, you can just be in a frame of mind where you can't believe it, and and you really do become married to it. So, I've made many mistakes over the years, and one thing I think that where I am now and just in my trading career is I've done a lot of heavy work, psychological work in the past couple of years that, not only has affected my trading, but this has affected relationships and just really every area of my life, because all these things are connected, believe it or not. You can't separate really trading from how you feel about other areas of your life and how you operate. And being able to, I've always been more of, in the past, kind of more of a black and white kind of guy. Like, I'm all in or I'm not in. And now to kind of moderate that and be able to say, yeah, you know what, I don't have to put it all on the line, or I don't have to be completely right. I mean, I probably lost millions of dollars trying to prove that I was right.
Yeah, so interesting.
Who cares if you're right or wrong? I mean, there's this saying in trading, it's better to make money than to be right.
Yep.
So it's really, but
and that is also a pretty good adage in relationships too.
Well, absolutely. Yeah, that's a good one, Justin. That's true. And
in my experience,
yeah,
definitely. And so being able to realize that it's okay to be wrong and to cut a loss and live to fight another day is this enormous if you're going to be successful in trading over the long term.
So Charles, what are some of the, so say you made a bunch of money in a stock and things like that, and you're taking some off, what are some of the steps now that you use to kind of moderate the all in, all out kind of behavior?
Yeah. So one is I keep some money on the side in the bank. I don't have all my money in the market.
Mm-hmm.
In the past, I've said, oh, I'm going to sell some, I don't, should never have to worry about money again. And then the moment I see an opportunity, out goes that money. I put it back right into the market because the thought of not trying to capitalize on every opportunity, like I just haven't been able to deal with that. And so now, and that's caused me a lot of stress. Like the fact that I actually have had moments in the past few years I've been worried about money is a real shame because I shouldn't have to, after all these years of trading. And so, so one thing is having reserves so you can live your life and not worry about what happens in your trading account. You can go through a long kind of winter in trading and still live your life and not be, worried about, either paying a mortgage or taking a trip or whatever, whatever your life expenses are. Another thing is, as I'm making money, I do pull money out of the market and just add to my savings. And I do that kind of on a regular basis. So whenever I hit like a threshold, and it's not like I take out all my profits and just play with the principal in a way, or the basis, because if you're going to grow,
right,
you need to have you need to actually make profits on your profits.
Right.
But it is I'll take like 20 to 25% of my profits and pull that out of the market. So on the one hand, I'm not capitalizing my potential in the market, but that's because I'm preferring to kind of moderate myself and have some institute some self-care and say, you know what, it's okay if I'm not the richest guy out there, or I don't again capitalize fully on every opportunity. So I think having that discipline to pull money out of the market on a regular basis, if you are making money, is important. And
Well,
I never really did that before until recently.
Well, I think part of that too is as you get older, it becomes even more important.
Absolutely.
It's one thing when you're, trading in your 20s and you don't have that much money and you can kind of come back from you could blow up your account in your 20s and you've got a lot of time to kind of recover from that. But, I'm not calling you old, Charles, but
I'm old. Trust me.
we're getting up there.
I sometimes don't recognize the guy looking back at me when I wake up in the morning. I'm like,
so I mean, would you say that, part of that too is kind of a reflection of being at a different point in your life where, that kind of security becomes more important?
Yeah, I think that's a good point, but I think that is a good habit to have, because I can look at, when I was trading 25 years ago and I was having some of my huge years early on, and the corrections that I suffered and the drawdowns that I took. This isn't my first rodeo when it comes to blowing up an account or near blowing up, or having a substantial drawdown of 50% or greater. I mean, that's happened over and over. And so I just think it's actually a good habit, even if you're younger, to pull some out of the market and pull some of your profits out of the market, and just, you don't need your entire net worth in the stock market. Buy some real estate, or just have some reserves. Have something safe out there. It's really and be able to do that without feeling compelled to put it back in because you see an opportunity that you just want more money for.
Right.
So it's really I think you have to build that habit, and I just think it makes sense, because I remember my therapist was, we were talking about my trading, and I was talking about my last massive drawdown I took in Tesla after I peaked in the end of 2021, when I was up, so much, 1,400% in 2000, and then another 200% in 2021. Like that on top of that, it was just
right.
The money was just so big. And she's like, any normal person would say, like, why not just take half out,
right,
put it in a savings account, you'll never have to work again, and play with the rest, which was still a huge figure.
Right. Yeah.
And like, it's almost embarrassing to say, yeah, I don't know why I couldn't do that. I mean, I actually do know why I couldn't do that at the time with all the work I've done, but just not being able to be kind of feeling satiated with my performance. Like I needed more. So that's something that I've kind of dealt with, that, once you're at a point in your kind of your self-actualization, or just your psychology, where you feel like you're enough, you don't need more, it helps in every aspect of your life, particularly trading, where you don't need to prove yourself. You don't need to fill your self-worth in any way. There's no hole in your bucket that you're trying to refill. It's just, you feel good, you're doing well. And trading is just an aspect of your life. It's not your whole life. It's not who you are. It's just a slice of who you are.
Mm-hmm.
So yeah, I mean, there's a lot of work to be done. I think there's too much emphasis on charts and chart reading and the technicals. And, this is a topic that just doesn't, I think, get discussed enough.
Right.
Because it's, managing your money successfully over a long, career in trading is a lot different than knowing how to read charts and, look for growth stocks and so forth. So, and you don't really realize it until you're in the thick of it,
Right.
So anyway.
Well, and I want to kind of bring up a point real quick, that it's, a lot of what you're talking about, there's this emotional aspect, this psychological aspect, and it should be made very clear where, some of this seems like obvious, right? And it's like, well, gosh, if, I'm too smart to make those mistakes. And I want to be very clear, smarts does not have anything to do with it. And this is something
it almost
that
goes against you. If the smarter you are, it almost goes against you, right?
And look, if you don't believe me, I've got 2 books for you to read. So 2007, if you want to kind of understand some of what was happening in 2007, in August, there's this book called The Quants: How a New Breed of Math Whizzes Conquered Wall Street and Nearly Destroyed It. This is by Scott Patterson, a staff reporter from the Wall Street Journal. So a good book, talks about, Ken Griffin and Peter Muller and, a lot of these guys, that kind of built that quant business. And then another one that I think is just, so telling: When Genius Failed. And this is The Rise and Fall of Long-Term Capital Management by Roger Lowenstein.
Just a class. It's just that whole scenario is just classic. Yeah,
because I mean, you literally had Nobel Prize winners,
the smartest guys in the room.
And to your point, Charles, you said that there were just some of these things that they just didn't think would happened, and they didn't have a plan for it.
Yeah, I think Bill would say, like, you can be the smartest guy out there, but it doesn't mean you have any common sense.
Right.
And common sense will take you a long way in protecting you. So yeah, I think that you're right. It has nothing to do with how smart you are. You don't really have to be, a genius to be a genius in the stock market, but you do have to be disciplined.
Yeah.
And you have to know when to have conviction and when to bail on that conviction.
Yeah. So when we come back, we're going to talk about some of the stocks that are on Charles' radar right now. Stay tuned. We'll be right back. We're back on the Investing with IBD podcast. Justin Nielsen here, along with Arusha Paris, who joins me every week. And we've got Charles Harris coming back to the show this week. He is a O'Neill Global Advisors portfolio manager and senior vice president. And we just had a great conversation on the psychology. I mean, Charles, at the master's program, you gave that psychology talk for years and years. And again, it just goes to show how important it is. And I think it's something that we all need to hear. And sometimes you even need to hear your own words repeated back to you. But let's talk some stocks. And we're going to start with a kind of a funny one, SharkNinja, which for some of you can call it Sharknado. Ian Ziering, if you're out there, we want to have you on the podcast to talk about SharkNinja if you can, because of your expertise with shark. So this is a nice IPO. It's been serious uptrend, great earnings report. What do you like about it?
Yeah, they just reported earnings, which are really strong. Actually, the CEO was on Mad Money. I don't know if it was this week or last week, but they had a really nice report, and it's nice to find some new merchandise that is, at new highs, and basically was able to come back after this hit we had in the market, and it didn't get hit nearly as hard as many other stocks. And it came back, in a very powerful way, big gap up. So yeah, I mean, I got into it on the gap up day. Always a little bit scary getting into a stock that's gapping up huge, but that's something that I've.
That was like 17%. By the close.
I think it was up even more at one point. I can't recall, but it was. Is that how much it was up?
Well, it closed up 16.9%. So yeah, it was probably up like 18-19%.
Yeah. So I mean, I have a position and I'm looking to add to it on a pullback. Probably will use the 10-day moving average to kind of guide me on this one. But yeah, I mean, there's really no shortage of merchandise out there.
What did you like about? Just technically, we can. What did you like about?
Well, I mean, fundamentally, it's strong, right? I mean, it's for one thing, I'm actually a consumer. I mean, I actually have a Shark vacuum.
Okay.
I think I also have a blender. I mean, I have a
Ninja. Yeah, so that's probably a Ninja blender.
Yeah, I have a bunch of stuff. I mean, they sell a lot of stuff at Costco.
Yeah, they do.
And it's pretty good stuff. I mean, I've had I actually have a Shark vacuum, and I have an iRobot vacuum, and I think they both work. But the Shark vacuum was like at least $200 cheaper. Wow. They both do the same thing. So yeah, I kind of like the space. What they do is they basically it's a little bit faddish. I mean, they look for things that are working, or like new inventions, and they kind of rip it off. That's kind of, I mean, I hate to say it, but that's kind of what I think they do is they'll find something that's really cool and they'll mass produce it, and maybe they'll throw on an infomercial or something. But I mean, it's a little bit, I think some of their products are faddish, but they're actually pretty high quality. And at least I've been pretty pleased with them, and they're reasonably priced. We got solid fundamentals, stocks growing, earnings and sales. It's hard for me to see on this little chart here, but it's not incredibly super high PE. It's just got good solid fundamentals, and it's the first one to kind of perk up in a market that's followed through and is starting to move up. So kind of thinking of it as in 2007 when Baidu came right out of it so quickly and was the leader in that time frame. I don't know if this is going to be the leader, but it's it's solid, and it's arguably a second stage base coming out of the IPO period. So I think it has further to run. So
and it's kind of nice that again, as we mentioned at the outset, there are a number of areas outside of tech. Tech has, got some great looking charts, but outside of tech, there's some even better looking, and so this is in the household appliances wares, something that you normally think of as kind of more on the consumer side that is, not necessarily as related to tech. So
yeah, if I mean, I don't know that it will be kind of a boon for this type of stock if housing begins to pick up with when mortgage rates, which are already starting to move down. They could benefit from people, buying goods for their home or their kitchens or vacuums and so forth. But they have dozens and dozens of products in different areas. So yeah, I this is one I like.
Yeah. Let's go ahead and move on to a health stock. Eli Lilly, of course, has gotten a lot of play because of the weight loss drugs, diabetes that turned weight loss drugs, but they have a lot of other drugs too. Alzheimer's, endocrinological, cancer. They just kind of run Crohn's disease. They have a lot of different treatments. What do you like about Eli Lilly here?
Well, also they seem to keep finding new uses for these GLP-1s.
Yes.
So I mean, there's so many markets I think that these drugs can or maladies that these drugs can treat. But again, this is another one that had a pretty sharp pullback to the 200-day and is coming back up. It's certainly not a new name. People have been playing this for a while, but it's this. When a stock comes up this powerfully and gapping up on a great earnings release where they kind of blew everything away, this is a leader in that space. And if if the market does calm down for a couple of weeks and this builds a handle, just that huge gap up on volume coming up the right side, that's a sign of strength. So, it's in the right space. They're the leader in their space. And, if you're going to put your bets on, I want something that's actually near a new high early in this recovery. So
I should mention some very strong relative strength lines that you're bringing up here between SharkNinja and Eli Lilly. And we might as well go ahead and add another one here with Palantir, PLTR. Now, this is a little bit more in that tech space, computer software enterprise stock. Man, this had a great showing at its IPO. It was all anyone could talk about. And then basically, gave it all up. And now here we are almost back to those old highs. Yeah.
And they also had a great earnings report. I don't currently have a position. I had a position and I kind of trimmed it into the strength, or cut it into strength.
This can be a hard one to buy on strength. I feel like it's a tough one because not only is it a little bit more volatile, but if you buy on strength and it comes for a normal correction, it can be painful.
It is a tough one, and I normally prefer to buy. I mean, this is like I consider this an AI stock in a way because they're using artificial intelligence in their software. It hasn't been a stock that has been a great trender. Like you're right. Every time it pokes its head up, it seems to get hit. So I think you've got to be careful with it. But it was a really, really strong report. And again, it's at new highs, where the market still has a ways to go to get to new highs, referring to the NASDAQ. So, maybe we see, AI is, I think, a theme that is going to be around for a long time. And right now, NVIDIA has primarily been the one huge winner in that space. And in hardware has been, they're selling all their chips. So hardware has kind of been where it's at, but soon, or what I would expect would happen is that the users of AI and this is a user, software company, the benefits will kind of accrue to the users, implementing AI as opposed to just the chip makers who are selling the capabilities. So
the picks and shovels, if you will.
Right, exactly. So
well, since you brought it up, let's take a look at NVIDIA, just to kind of as a comparison. And I do have a position in NVIDIA myself.
Yeah, I have a position as well. And yeah, I mean, NVIDIA is also had this sharp, 36%. Yeah, 36% correction off the peak, which is pretty extreme. Is that the 200-day line, the red line, or the 50? It's not the 50. Well, so it came into the top of the prior base, got support there, and is coming up. Now it's coming up against the declining 50-day, which I mentioned earlier. On the daily may offer some resistance, and that would be completely normal. So, if so, they report also at the end of August, so we always have to be a little bit careful going into an earnings release. But I don't think it's likely that the move is over in NVIDIA. So it's another stock I own, not as heavy as I did, but if it kind of bases out a little bit, maybe takes a little break, sells off a little bit, and gives kind of a more, it continues to move up, get up above the 50, and maybe builds a handle. This can be something that can have another run in it. So,
kind of on the AI related for picks and shovels is ANET, which has been doing pretty good. Arista Networks.
Yeah.
This is in the computer networking. Now, I don't like this downside reversal that it had where it popped above 350 and then immediately got slammed. But barring that, this is not a bad looking chart.
No, I actually have that on my list as well. I don't currently own it, but it's a stock I have owned. This actually looks more similar to many of the stocks in that 2007 period that got hit. Where they had these, pretty sharp, quick sell-offs, but they came kind of right back and built little bases. I agree that's a little bit, weird, that downside reversal, but given the environment during that period, and also given the fact that it was a good response on earnings, and then it sold off. That
until it wasn't.
Yeah, but again, it was the market. It was a really bad time in the market. So, it just goes to show when you're in a bear market, or the buy switches off. The M and CANSOM is so important, regardless of what you own. I actually pay more attention to market school now than I ever have, because it keeps me from sometimes really arguing with the market. When oftentimes if you're concentrated in just a small number of stocks, you're focusing on those stocks much more than the market. But if you're getting into trouble in the general market, they all come down. So I like ANET a lot. I think that this one, all these stocks aren't at, I think, perfect buy points, but I think keep an eye on them, because they can, I think they can all work if the market continues to work.
You know what? Let's go ahead and take a look at a financial one. The NASDAQ. Now this isn't the composite. This is NDAQ. The owner of the NASDAQ stock market and exchange. So some of these financial exchanges have started looking a little bit better. What do you think of this one? I mean, it came right down, got support at the top of its base, and basically support at the 21-day moving average line, which is the pink line here. I assume that's the pink line. Is that right, Arusha?
Yes.
Yeah. Okay. So got support at the 21-day moving average line. So whereas you had all these stocks coming down to their 200-day lines. This was only coming down to the 21-day. Didn't even test the 50-day.
Yeah, no, it's great. I actually have a position in it, and it's yeah, I think it looks really strong. I like having some new merchandise. Broke out of a nice looking base. Again, as you mentioned, pulled right back in to the base and then held at the 21-day moving average. And if the market, you know, begins to work again, you know, following this follow through day, there's a large pipeline of stocks that want to go public. I mean, it's been a really kind of a sparse year for new issues, and it's been that way for a while. So there's a lot of stocks.
Yeah, kind of peaked in 2021.
Yeah,
where you had all those SPACs and stocks coming public, and then
yeah, it's been years.
2022, you know, the bear market, no one wanted to stick their neck out.
Well, a lot of those stocks, like super speculative stocks, peaked in February,
Right.
you know, early in 2021. And it's been a terrible market for new merchandise. You know, there's a lot of private companies, and there's, with this AI theme, which is I think a huge secular theme, there's going to be so many stocks that play in that area. Mm-hmm. And this should be a huge positive for a stock like NDAQ, where many of these stocks are going to be listed on NASDAQ. So, so yeah, I think that this is kind of more of a play on a stronger market and more, basically more listings.
Let's do one more. This is Shift4 Payments, FOUR, another financial stock. So in the payment space, you can probably see some of their equipment as you go to the counter and pay for something. I'm not sure what to call this base. What do you think?
It's a fintech company, first of all, and this space is started to perk up. Even Upstart, which is, fell from 400 down to, I don't know, 15 or something. Perked up recently, reported earnings a couple of days ago and was up like 30% or something. So, fintech's been out of favor for quite a while. Sometimes it's hard to define exactly what you would call this space, but I always say that even if you can't exactly say what it is, where the buy point is, like, where the resistance was at the, right. Over the past 5 weeks, and look at the huge upside reversal and huge volume. I think that's coincided with the earnings and the follow through day that you've had since then. Super powerful. Now, in my opinion, it's extended now. I wouldn't want to, I think, buy it right here, but this is something that I've got my eye on, that I'm looking for it to rest and give another opportunity. This is a founder-led company. I was doing a little research on the guy. Just a super smart guy. He was really young when he started this company.
Like 16 years old or something.
Yeah, right? It was like great. I was like looking at it going, that doesn't really make sense. He was like CEO at like, I don't know, 18 or something. Yep. I'm like, it doesn't make sense. But the guy is like a phenomenal guy, and he's going to be going into space.
Right, exactly.
He's like an aeronautical, I don't know, engineer, pilot. He's just this crazy genius kid. Yep. So, now he's, has a family and all, but he's he definitely knows the space, and look at the earnings line. I mean, it's been a winner over time, and so I think it's a strong company, and I just like the action over these past couple of weeks. You can see these blue spikes in there on the volume and the strong price action. So this can offer an opportunity as well. Mm-hmm. Again, this is what I would want to be looking for following a steep swift correction and then a recent follow through day.
Mm-hmm. And again, some really powerful relative strength lines, especially recently on a lot of these. So thanks for doing that quick overview of a lot of stocks. Usually we only do 3, but I mean, with Charles Harris, we've got to give you more, right? So
of course.
Hey, man, it was a real pleasure having you on the show again. Great to see you, even though it's been, virtual the last few times. So can't wait to see you in person again.
Yeah, I know. We need to have a party. I'm telling you, when Webster's in town, I'm hosting. I'm going to host a dinner.
Okay, awesome. Can't wait.
Yeah, get them out here.
What about our listeners? Are they invited too?
We can do a raffle, maybe.
Right. Okay. Very good. Well, hey, it was great having you on the show. Thank you so much for sharing your insights. I think one of the things our listeners really appreciate is how open you are with mistakes and things that you are improving on, and how how honest you are with your whole journey and everything. So really appreciate it, Charles.
Appreciate it. Thanks for having me on.
As always. That's going to wrap it up for us this week. Thank you so much for joining us. We did go over a lot of charts today. So as a reminder, if you want to kind of check out investors.com/podcast, if you weren't watching, you might want to check out the video there. We're also available on YouTube, and at that investors.com/podcast, you can also check out, wherever you're getting your podcast, whether it's Spotify, Apple, what have you. You can sign up there, subscribe, like it. It helps us out. And next week, don't forget, we're going to have Jim Ropel back on the show. So if you have a follow through day and you get some little action there, Jim Ropel's the one you want to talk to. He loves a bull market. So that'll be a great conversation when we have him on next week. We hope you join us for it. See you next time. Bye-bye now.